Hi, my name is Jermal Chandler. I'm an on-air personality at Tastytrade, and this is the Spreads Term of the Week. A large portion of participants in the stock market tend to be buyers of equities. Consequently, when they want to use stock options to hedge, they are looking to either buy puts or sell calls. This leads us to a phenomenon called volatility skew. Volatility skew describes the observation that not all options on the same underlying stock and expiration have the same implied volatility assigned to them. In fact, for most stock options, the natural volatility skew in the market is such that downside strikes usually have greater implied volatility than upside strikes. A look at out-of-the-money call and put options provides the clearest view of this. Pull up almost any equity option chain and you'll find that the implied volatility of the downside put options is trading richer than upside call options. This is because the implied volatility in out-of-the-money puts is higher than the equivalent out-of-the-money calls. Price change velocity can also contribute to skew, since markets can fall much faster than they rise. Hi, my name is Jermal Chandler. I'm an on-air personality at Tastytrade, and this is the Spreads Term of the Week. The strike price is the set price at which an option contract can be bought and sold at expiration. Unlike stocks where investors must trade the current price, it is possible to choose different option strikes that are above or below the strike price. These option strikes have different premium values and probabilities of profit. When choosing strike prices, there are two crucial concepts: the probability of the option expiring worthless and the moneyness of the option. The latter determines whether the option is in the money, at the money, or out of the money. Out of the money options are made up of purely extrinsic value. The extrinsic value of an option is the added premium that compensates for changes in time and volatility. At expiration, out of the money options have no real worth. The in the money option portion of an options price is largely represented by intrinsic value. Depending on the amount of time left until expiration, there might be a degree of extrinsic value as well. Overall, it can be said that the strike price of an option is the most important determinant of an option's value.
Hi, I'm Russell Rhoads, Head of Research and Consulting for EQ Derivatives and a professor at the Kelley School of Business at Indiana University. The term today is the China A50 indexes, and I say indexes plural because there are a couple of versions, the MSCI China A50 index and the FTSE China A50 index. So how are they similar? Well, they both hold what we refer to as China A shares. These companies are China-based companies that trade in Shanghai and Shenzhen. For the longest time, they were restricted to domestic investors, but since 2003, select foreign investors have been able to purchase these shares through what they refer to as the Qualified Foreign Institutional Investor System. It goes with logic that they both have 50 stocks, but there are slightly different components to each. For example, one exception, Contemporary Amperex Technologies. It's one of the top 5 holdings of the MSCI version at 6.2%, but only 2.14% of the FTSE index. The largest holding for each is Quichao Monte. It's a beverage company. It's 9.55% of the MSCI index and 11.64% of the FTSE China A50. Both do have active ETF and futures markets. However, slight differences here. The FTSE China A50 index, those futures trade at the Singapore Exchange, and they have made a concerted effort with respect to the FTSE China A50 index to make sure that the components are not following under any U.S. investment restrictions. The MSCI China A50 index, those futures trade at the Hong Kong Exchange. And then finally, we do have a third A50 index that was recently launched, the MSCI China A50 Connect Index. As I said, relatively new, holds the holding focuses a bit more on new economy stocks, and futures were just recently launched in Hong Kong. In fact, I think they just went through their first futures roll in the middle of November. So a summary, the China A50 indexes, they're all good representations of equity performance in China. Both the FTSE and MSCI versions have futures and ETFs available for trading. And there is a recent addition with that MSCI China A50 Connect Index.
Hi, my name is Jermal Chandler. I'm an on-air personality with Tastytrade, and this is the Spreads Term of the Week. A European style option is a version of an options contract that limits exercise rights to only the day of expiration and never before. For example, if an investor has a call option that matures on January 21st, then they can only execute it on January 21st. That said, the exercise limitations do not prevent investors from buying and selling the option freely throughout the life of the contract. Many index option products are settled European style. Another distinguishing factor of European style options is that they settle into cash. No shares exchange hands. The option owner receives the cash value of the option, and the option seller pays the cash value of the option. That cash value is equal to the option's intrinsic value. If the option is out of the money, it expires worthless and has zero cash value. One complicating factor with European style options is the settlement price. For monthly contracts, at the close of the market on the third Thursday of the month on European style options, trading is ceased. However, the settlement price of an option is determined by the opening price of the index components on the morning of the third Friday of the month. If there is significant movements in the price of an underlying asset, the settlement price of the contract could be somewhat surprising. Furthermore, the settlement price of the contract is often not published until late in the morning on Friday, so the settlement price could remain unclear for some time. Weekly European style options can have various final trading and settlement dates, so it's best to look them up for the security being traded prior to execution. The tax treatment for European style options is a little bit more favorable as they receive the IRS Section 1256 tax treatment. This means that 60% of the gains can be counted as long-term capital gains, which would be at the lower 15% rate. 40% of the profit can be taxed as ordinary income. Naturally, one should consult a tax advisor for more information. Ultimately, investors need to be aware of the type of option they buy and sell, especially if they plan to trade or exercise the option on its last possible trading day. In addition, remember that European style options have different characteristics than the more popular American style options.